I'm Charlotte McLeod with investingnews.com, and here today with me is Bert Dohmen, founder and CEO at Dohmen Capital Research. Thank you so much for being here. Great to have you.
Nice to be with you.
Really good to be speaking with you for the first time. I'm excited for the conversation. And where I thought we could begin, just because we haven't spoken before, is with your broad view on the U.S. economy. I know there are a lot of warning signs out there that are causing concern for many members of our audience. So what is your overall view right now?
The U.S. economy is weakening as we speak. I always say people don't believe the jobs numbers coming out of Washington. They're totally fake, and there's not one bit of truth in those numbers. They use seasonal adjustments and never explain how they make those adjustments. And I said jokingly, in my opinion, they just call the White House and say, "What number would you like to have for jobs?" And the White House said, "Well, let's have 500,000 new jobs." I say, "Okay, done." That's about as reliable as they are, very similar to China. And so I don't trust them. I trust the exterior signals. For example, in the last 6 months, big company layoffs that have been announced by the companies. These are real numbers, okay? 720,000 jobs have been lost in the last 6 months. 720,000. You don't see that reported in the government's jobs numbers. You don't see that. And everything is fake. For example, people don't realize that anybody who has not looked for a job for 30 days is not counted as unemployed. Isn't that amazing? You just don't exist anymore if you haven't looked for a job for 30 days. How is that possible? We were supposed to have a civilized country here with true statistics, but we don't, and that's really very, very sad. So we have to look for other signals that tell us what is really happening versus what the government tells us what's happening. Unfortunately, the guys on TV always quote these governmental numbers as if it were the gospel. These are true. Well, who would question the government, right? The government is known to be so honest. So actually, that's a fable. And so we do our own research. I've been doing this for many, many years. Probably more than anybody in the business today. And it's amazing how much you can learn over a period of time.
Yeah, I would love to hear more about where you are looking to find true numbers on what's going on, because I know it can be very confusing for people who are maybe following mainstream media and hearing those numbers that we know are often inaccurate.
Yes, we look at, for example, even some of the websites, like the BLS, okay, it stands for Bureau of Labor Statistics. I say it stands for Bureau of Lying Statistics. Okay, so we go to their actual website and we take the 15, 20 minutes to look at the real numbers, because they are there. You just have to look for it pretty hard sometimes. And we look at seasonally unadjusted numbers. The ones that you hear on TV are always the seasonally adjusted, okay? That means they're fudged, okay? They're phony, fudged, unbelievable, okay? So you want to look at the seasonally unadjusted, okay? For one example, in January of 2023, the government came out with, I think it was 514,000 new jobs have been created in January. That was in the February report. I said, that's impossible. January is always way down because the seasonal workers are laid off, And so we looked at the website, and the actual job change number was over 2.5 million job losses. They report 2.5 million job losses as 500 million job gains with their seasonal adjustments. This is ridiculous. So, and this is what we've been seeing. If you take a look at, we showed in our Wellington letter all the time, the actual number of what they forecasted. And then later on, 1-2 months later, you get the adjustment, and it's always much worse than the initial report. But nobody pays any attention to the follow-up adjustments. Nobody pays attention. So the headline number is, strong job gains, 500,000 new jobs, And then later it's, so only 100,000 new jobs, but nobody reports on it. Nobody pays any attention. So by looking behind the scenes, you can be much more accurate. and see what's really happening. So what's really happening right now, our numbers and our work shows that jobs are being lost right and left, and eventually that leads to consumers who get to be very careful about spending their money. We have the highest default rate now on credit card loans in history. The highest, 29-30% interest that you pay on a loan against a credit card. Is it any wonder? You cannot pay 30% interest and stay solvent. This is ridiculous. But people that don't have that, our educational system is terrible. So people don't learn that taking on excessive debt, especially at the interest rate of 30%, is going to lead to bankruptcy. Now we have the highest default rate on student loans ever. Where do you hear that? Maybe once in a while, if you're lucky and watching the right podcast, you will hear that. Podcast is now, in my opinion, the only place where you get more realistic news. People have to start abandoning the traditional media because it's all fake.
I think I really agree with a lot of the things that you're saying there. And so these are the statistics, the numbers that you are looking for. There's been a lot of talk about whether the US is heading for a recession or something worse. So I'm wondering how you see it, keeping in mind all the things that you've gone over. And why haven't we seen something like a recession unfold yet?
How do you know we're not in a recession?
Good question.
The GDP numbers. Do you know that governmental spending, our huge trillions and trillions of dollars of spending, are counted as GDP? So the more fake money they print, the higher the GDP number goes. So if you have hyperinflation, you will never see a recession in the media. Hyperinflation's, why wouldn't you be in a deep depression, hyperinflation, where so nobody can afford to buy food? No, GDP will be growing by leaps and bounds the way they do it now. See, our statistics are so flawed. How can you add governmental fake spending or printer money spending as part of a good economy? No. It shouldn't be counted as that, or they should have an alternate statistic, and there are some, but nobody reports on those. Like gross domestic income is an important number, but whoever hears about that.
Very true. And so I'm curious about your thoughts on what we might see from the Fed moving forward into the rest of this year. So they are working from the official statistics. You are looking at your numbers that tell you something different. What do you see as the Fed's path forward when it comes to interest rates in 2025?
Nobody can know because nobody knows. Even the Fed doesn't know what they're going to do. They say they are data dependent. That is terrible. Our whole business is based on research and making forecasts. That's what people want, is forecasts. And the Fed works on data dependent numbers that came out based on what they saw over the last several months or 6 months. They're driving a car looking only in the rearview mirror. You're going to crack up if you do that. You want to look forward. You want to be able to forecast. They got 400 PhD economists, and they cannot forecast where the economy is heading. They have to depend on 6 months old numbers that are coming out. This is ridiculous, but it's never been any different. Don't blame Powell for it. It's never been different. Then the Fed was invented in 1913. It came, and it was basically to perpetuate a huge scam. And we've had that scam since 1913. They can manufacture money out of thin air anytime they want to, and as much as they want to. And that's why my view, a lot of very intelligent and well-known people are talking about, there's going to be a crash of the economy because of excessive debt and so on. No, I heard that 40 years ago. And when a $2 billion increase in the deficit was considered, that's the end of the world. $2 billion of debt more, Now we're counting in trillions, it's so much more, trillions of dollars, and the economy has not collapsed yet, and it won't. Look at our debt to GDP in the US now. You say, oh, it's alarming. It's 130%. No, it's not alarming. Japan is doing very well, and their debt as percent of GDP is 255%, almost twice as high. And the economy is not collapsing. And China is even bigger than that. And it's not, well, China is a different story. China is collapsing. But they don't tell you about it. They have a different form of government than we do, which is even worse.
Very, very interesting. I think a lot of the time when conversations about the Fed come up, we have to talk about inflation. So curious on your views on where we may be headed with inflation, because that's another one where the numbers can get very confusing.
Yeah, that's a good question right now. And it's something I think about every day. Every day. Yeah, of course. You have to reanalyze what your previous forecast was based on, but if something has changed. That's so important. Always reanalyze. Never be afraid to say, hey, things have changed. I got to change my forecast. That's important. It's not bad to be wrong, but it's bad to stay wrong. That's the important thing. And so right now, I think we're in a decision point, the proverbial fork in the road, And there was a famous philosopher, Yogi Berra, and he said, if you get to a fork in the road, take it. So he didn't say which way. So we are there now. We have the choice. Just like in 1978, Arthur Burns retired. He was the head of the Federal Reserve, and G. William Miller, that nobody mentions anymore because they blame the inflation on Arthur Burns, the prior guy. No, the inflation was caused by G. William Miller. And I remember that so well because my business was 1 year old at the time. And he said, we're not going to fight inflation with tight money, but with interest rate policy. Now, at that time, tight money was still a good definition. Tight money was inability to get loans for credit-worthy borrowers. Credit-worthy small business would go to a bank, say, I need a loan of maybe $100,000. Bank would say, we'd love to give it to you. We know you're good for it and so on, but we just don't have the money. Okay? And the Fed controls that by controlling bank reserves. Okay, so that's the important factor. And so I developed the Dohmen theory of credit and liquidity at that time. Those are the only two factors that can determine the long-term trend of the stock market. Credit and liquidity. If those two are expanding, the market has to go up. It doesn't matter what earnings are and dividends and buybacks and all this baloney. Those are just the ripples. You want to know if liquidity and credit are expanding. And that is, when they're not, that's tight money. Okay. Now, many people confused why interest rates are going up. In 78, what put our new firm, on the map in Wall Street was that I said, that means interest rates are going to double and triple. They're going to go sky high along with inflation. And that means stocks will become inflation hedges. Now, that was totally, according to one Wall Street economist who was doing a seminar, and I asked him after the seminar, the Q&A period, he was forecasting a peak in 12 3/4 in the prime rate. I said, our forecast is 20%. He said, that's absurd. It would never happen. I said, and the stock market will rise during that time on the way to 20%. He said, that's impossible. Rising interest and rising stock doesn't happen. I said, yes, it will. If the stocks act as inflation hedges, because they do. Companies can raise prices. When liquidity is ample, when people can get loans, they can get credit card loans and so on. So that is not tight money. So interest rates can only rise for two reasons. One is tight money, the scarcity of money, and then interest rates rise, but it's very bad for the stock market because stocks become a source of cash. People sell stocks in order to get cash. Okay. The other reason for rising interest is inflation expectations. Yep. And that has very good consequences for the stock market, bad eventually for the economy, eventually. But while it's happening, it's great. The 1978, 79, 1980, great times to speculate in commodities. We even started a commodity newsletter at the time because everybody wanted to speculate in commodities, which included gold and silver. So we forecast the whole big rise from $123 to $800 gold. Okay. And then when it was $800 in 1980, we said, well, which is the long-term study on cycles, and we're going into a bear market in gold now, and gold should go down to about $300, and the bear market should last about 20 years. People thought that was crazy. A 20-year, I mean, people were looking for $3,000 gold in 1980. They said it's not going to happen this time around. And so our cycles said there's going to be a 20-year bear market, but cycles shift to the left, to the right. They're usually not that accurate. This one was right on the bottom. 20 years later, in the year 2000, was the bottom of that bear market in gold. Okay, so our study in 1980 also said, and that will be followed by a 31-year rise in gold prices. And we even said we have no idea what would cause a 31-year bull market in gold. And we're talking about a secular bull market, not a cyclical. Secular is a long term. And so that will be interrupted from time to time with bear market. It's not straight up. Nothing in this world is straight up. Okay. Nothing is linear, except the line that you may draw with a ruler. That may be a straight line. But now we've got about 6 years to go according to that cycle. Now, the cycle can come top earlier, a few years, or later. That could happen. So that may depend on what the Federal Reserve does. But I think with the central banks worldwide are now in a position where they have no alternative but to create new money out of thin air in order to pay the debt. Everybody's over indebted. And so that will force them to create more debt to really fuel inflation. So I have, and if inflation rises, don't blame Powell or anybody else. It's just the debt creation. Who produces debt? It's the Congress that approves the new deficit spending. We're now having this BBB bill, the big, bad, beautiful piece of garbage. And so it's it's going to be improved one way or another. And so more deficit spending, trillions. So anyway, but one thing I want to alert people to, they're going to have advertised how many trillions this will expand the deficit. But they will be counting what's ending is the Trump tax cuts from this first term. They're ending. Okay. So that will, of course, the initial phase of those tax cuts. Now, when they are made into law, so they're not going to back to the old high rates. That is actually very, very beneficial for the economy, But the way the budget office works, they don't care what the good consequences are. They say, it's going to increase the deficit by, I think, $3.7 trillion. Yeah, they never say by what. They increases their previous forecasted deficit, and their forecasts have never been anything near to being right. They're always wrong, but they don't tell you that.
Yeah. No, so, they wouldn't. Anyway, yeah.
Yeah. So, twice a month, usually, we publish the Wellington letter. It's 25 pages, single space. There's so much content, you will find nothing similar anywhere at any price. I think we charge $69 a month, something like that. And so it's really worthwhile, but it's only for serious investors, people that want to read about and see why it's happening, not just don't bother me with the details, just tell me what to buy. No, we don't do that. We will bother you with the details.
Great information, and I will put the link in the video description so people can check that out if they would like to.
Thank you.
And
Yeah.
you're going in exactly the direction I was hoping to go with gold. So you mentioned we're in a 30-year cycle right now, and 6 years left to go, I think is what you had said. So
Yes.
can you talk a little bit more about your outlook for gold? I think people are really curious right now. Of course, it's been a great year for gold, but everybody's curious where the price goes from here. So what are your thoughts?
Well, I think gold and silver. I have to include silver now. Silver has been kind of dull over the last several years, but silver eventually will be the key. And I had an interview just recently with Daniela Cambone, and we talked about my experience as a kid in Germany. I was a little kid during the World War II, and so when it ended in May 1945. The Hitler currency, paper currency, nobody wanted that. It was a piece of junk. Hitler died, committed suicide, and so, but they still, because there was nothing else, they would take it if you really need something, some groceries to feed the family. But nobody really wanted. But if you had the silver coins that had been in circulation in the 1930s, and they were basically from Austrian-Hungarian Empire. And it was called the Maria Theresian Thaler, Thaler, which was the predecessor of the U.S. dollar, And so everybody knew its silver content. Everybody recognized it as a coin. And boy, if you had those, you went to a grocery store, they would take you into the back room where the good stuff was, like maybe even butter, because the regular butter was basically made out of petroleum, and it tasted like petroleum. It was pretty off. The only sugar we could get was brown sugar, which now, of course, is considered healthy. So, but we really yearned for some real sugar, white sugar, and stuff like this. I mean, it's kind of interesting to think about, but silver coins really enabled you to survive, more or less. And my parents had a bunch of them. They had always very good foresight, because when Hitler declared war on the United States, my parents were in a streetcar, and he burst out, said, "That idiot," and the guy next to him said, "You call out Führer Hitler, I demand to know your name, or I will report you." And then the air raid sirens came, the streetcar came to a halt, everybody ran to the nearest shelter. So that was lucky for him, because they probably would have arrested him for saying that, Yeah, but anyway, but you have to plan ahead. And if things come towards everybody now, it's crazy. Oh, Bitcoin is going to be the real money. No, when the internet goes down, you're broke. You're broke. How are you going to prove to anyone that you own any Bitcoins? The internet is closed. Your money is stuck. Okay, so how is that going to be as a substitute for real money? Real money is going to be like U.S. silver and gold coins. Some that spindle, something that people write. And I would say, don't buy numismatic coins, that have collector's value, because there's a lot of fraud going on in those. Okay, so don't buy collector's coins. Buy coins of known value that have been printed, or made, let's say, 100 years ago, and buy the U.S. Mint.
Makes a lot of sense. So gold and silver coins, people need to have those. Do you see opportunity in gold and silver stocks, the companies at the moment?
Yes, good question. Mining stocks, I've not been in favor of mining stocks for a number of years, because the gold has actually outperformed the mining stocks. And mining stocks are subject to lots of problems. If the mines are in, let's say, in Africa and some of these countries are saying, "Oh, you found a lot of gold. Okay, we're going to take that mine away from you." So you have no protection. What are you going to do? They also are subject to mines flooding, to wages soaring, etc., all kinds of problems. But right now, I think we're in a period of, and I don't think it's going to be a long-term period, maybe a year at best, where mining stocks will do catch up, because they're going to be reporting big increases in earnings, But after that, they're going to again become subject to the traditional mining problems. So the safest, if you're really concerned about security, the metal itself, monetary metals.
I think it makes a lot of sense. And so many people are concerned about safety right now. I'm wondering, so we've talked about gold and silver, the physical gold and silver. This is where you go to be the most safe. Are there any other areas of safety right now that you are looking at?
We have a program called Hedge Folios, and you can go there, hedgefolios.com. We have 5 model portfolios that people can replicate. We don't manage the money, but we manage kind of the model portfolios. They give you the names of, they're all ETFs, not stocks, ETFs, for which give you great instantaneous diversification. That's important, diversification. And so we kind of manage that. We've been basically in about around 80% cash equivalents, and precious metals since February. So that's when the big decline started. A huge decline, was basically almost like a crash in the stock market, and then now we came back. Now we all hear about the great performance of stocks, but just imagine, stocks just now made a new high above the February last December high. So you went the whole way down, and then if you didn't panic at the bottom and sell, then you were now almost back to even, almost. But the real number is, although an index like the S&P was at a new high today, and the Nasdaq. Okay, the S&P, only 8% of 500 stocks are also at new highs. Only 8%. That's 40 stocks out of 500 stocks. Basically at new highs. Although everybody talks, the S&P 500 is the new high. No, it's only 40 stocks that are at new high, not 500 stocks. And the Nasdaq, it's only 10% of the Nasdaq stocks are at new highs at this time. So this is all phony baloney. It's called a very narrow up. And as we do advanced technical analysis, it's the only thing that really works. And so in advanced technical analysis, a narrow up move in the market always is a sign of a trap for the bulls. It's a trap for the bulls. And we've been forecasting that for the last, since the April bottom. We said, we're probably going to go to a new high in a major widely watched index like the S&P 500. It's going to be by a small amount a new high, and that's going to close the bull trap. And we said that. And we're going to see if we're wrong or right, and over the next several weeks. So, but you could do that. But the participation is so important. When only 8 or 10% of a big wide index makes a new high with the index, you notice something fishy. I smell fish all day long when I look at the markets.
Well, it really shows how important it is to look beyond those headlines and actually do just a little bit of digging so you know what's really going on. Yes. I think we've covered so much ground. This is what I wanted to cover with you, but before I let you go, are there any final thoughts that you would want to leave investors with right now? I know it's very interesting times to be in the markets.
Well, in this type of environment, now we used to have a saying, we had all these old sayings, traders in the markets years ago. I don't hear them anymore, and I kind of miss it. But one was, there are always times in the market when he who loses the least does the best. Okay? So be safe right now. We've been writing since the beginning of the year. No leverage. Don't have any leverage. Don't have any leveraged ETFs. Don't have any naked call options. All these things are like dynamite, and that dynamite is going to explode in your face. People don't realize that if they have a margin account with a brokerage firm, they can lose their whole house. They can lose their house. They can foreclose on their house. I remember after the 1987 crash, where the Dow Jones was down 22.6% in one day. And we had sold out about 4 weeks ahead of time. He said something fishy is happening in the market. Something is wrong. It's going to be a bad problem sometime ahead. Then we had the crash. Okay, so and then later on we found why we had a crash. But Wall Street already knew what was going to happen. See, that's it. In the bear market, you have to have. Some people have to hold all the stock. The stocks are outstanding, right? So somebody has to own them on the way down, right? Does it make sense? Wall Street doesn't want to own them on the way down, right? So they elect the average investor. The average investor becomes the bag holder. And the bag holder is a term Joe Granville, who was a very well-known analyst and a friend. And he always called him, don't be a bag holder, So don't be a bag holder into the next decline.
Well, perfect place to end, I think. So now is the time for safety. Thank you so much for coming on to go over what's happening in gold, silver, and the markets. This was really great.
Yeah. Thank you. It's really a pleasure to be with you. I wish your listeners and viewers all the best. Be alert. Don't get greedy. Greed is going to be your big enemy. I remember one story. There's Jesse Livermore. He was the greatest short-term trader of his time in the big 1920 bull market. Okay. And then there came the crash and so on. In the mid 1930s, he said, I was a big short-term trader, but the big money is in the longer term. And I think that's something that in this environment, I used to be short-term trader. One time I made over 15,000% in an option contest, trading real money, not fake money. And so I've traded. I don't trade options anymore at all because the game is fixed right now. People don't realize that high-frequency trading and the algos, they totally manipulate the market. 80% of the orders are from high-frequency trading. 80%. How do people with trading from their laptop think they can compete with computers? They can enter 90,000 trades in 1 second. In 1 second. Trades, not shares. Trades. Each trade is maybe 10,000 shares. This is incredible. And you want to compete with your laptop?
Yeah, probably not going to go very well. Yeah.
Okay. So I wish you all the best. Thank you very much for the opportunity. My whole effort right now is to alert people. This is not rational what the market is doing. Just think of it logically. The market is a new high. That means that economically we should be at the most wonderful time in the market that we've seen in history. Right? Isn't that what that suggests? Do you think this is the most wonderful, the safest time in world history?
No.
With the U.S. dropping huge bombs on the country that we've never declared war on? That was a sneak attack like Pearl Harbor, whether you agree with it or not, but, it's not the kind of thing that we used to do as a country, Yeah. Okay. I'll let you go.
Yes. No, this is so informative. Thank you very much. And we'll be sure to have you back again soon, hopefully. But for now, I'm very good. And I'm Charlotte McLeod with investingnews.com. And this is Bert Dohmen.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.